Welcome back to the Deep Dive. So today we're taking a bit of a different angle.
Yeah, less about the specific rules and regulations, the letter of the law.
Exactly. We're going deeper, looking at the moral architecture of financial advice. What's the ethical foundation supposed to be?
That's it. We're looking at sources that aren't just quoting the FCA handbook. They're trying to pin down the standards that should guide advisors and firms, things that go beyond just what's legally required.
So the mission, really, is to pull out those core principles, the kind of moral compass for when the rules maybe aren't crystal clear.
Right. And for you listening, this is about understanding what standards you should expect from the person handling your money. What does acting ethically really mean when big financial decisions are involved?
Okay, so let's define it then. Ethics here means what?
Well, at its heart, it's about moral principles guiding conduct. It's that duty of care, doing the right thing, even when nobody's checking over your shoulder.
Which is critical in finance, right? It's built so much on trust.
Absolutely. It's the foundation. Clients are vulnerable, they're sharing sensitive information, trusting someone with their future. Ethics holds that whole relationship together.
And we know from history that foundation can be shaky. What did the industry learn from past mistakes? When did they realize just ticking compliance boxes wasn't cutting it?
Oh, they learned the hard way, definitely. Following the rules isn't the same as earning trust. Think about the big mis-selling scandals we've seen.
Right, huge ones.
Yeah, or conflicts of interest where the firm's profit clearly came before the client's well-being, or even just designing products that were deliberately confusing.
And that damages confidence across the board.
Hugely. It erodes public trust. The big lesson was, if the underlying culture allows for ethical shortcuts, just having compliance checks, well, it's not enough. Those checks will eventually fail.
So there's this constant tension.
Always.
Yeah.
Balancing the need to, run a business and make money against that fundamental duty of care you owe to the client. It's about moral reasoning, not just legal loopholes.
Okay, so let's unpack the framework our sources suggest. They talk about 4 key pillars, sort of the guiding stars for conduct.
That's right. The core principles: integrity, objectivity, professional competence, and confidentiality.
Let's start with integrity. Seems foundational.
It really is non-negotiable. Integrity means being honest, straightforward, transparent, consistent, basically moral soundness.
Sounds simple, but where's the real challenge? Where does it get tested in practice?
Well, it's often in those gray areas, especially around disclosure. An advisor with integrity, they won't manipulate information, obviously. They won't hide risks just to make a sale or push something that benefits them more.
Okay.
But the deeper challenge is this. Integrity isn't just about handing over a document filled with fine print. It's about making sure the client actually understands that fine print.
Ah, right. Not just ticking the box.
Exactly. When you present a financial product, the ethical thing is to clearly explain both the good and the bad, the benefits and the drawbacks, in language the client can actually grasp, so they can make a truly informed decision.
Not just a legally covered one. That makes a lot of sense. Okay, pillar number 2, objectivity.
Yes. This means advisors have to stay impartial, unbiased. Their advice needs to come from facts, from solid analysis, not from their own emotions or, crucially, financial incentives.
And this is where conflicts of interest really creep in, isn't it?
Oh, absolutely. This is often the ethical minefield. Objectivity gets compromised when, say, an advisor pushes their own firm's products, even if better options exist elsewhere.
Or when they favor products that just happen to pay them a higher commission.
Precisely. Or even just aligning recommendations with their own personal investment preferences rather than what the client actually needs based on their situation. Keeping objective ensures the advice is genuinely focused on the client.
So the acid test is asking,
would I still recommend this exact same thing if I wasn't getting paid for it, or if the commission was 0? That's the gut check for objectivity.
But practically, advisors need to earn a living. What if there are 2 funds? Both seem pretty suitable, but one pays slightly more commission. Is choosing that one automatically unethical?
That's a great question. It gets into the nuance. The ethical line is crossed if that slightly higher commission comes with any material disadvantage for the client.
Like what?
Like maybe slightly higher hidden fees inside the fund, or it's less liquid, or the management team isn't quite as strong. If the client's needs aren't put absolutely first, even in small ways, choosing the higher paying option breaches objectivity.
So transparency is key there, too.
Total transparency. And often the best ethical practice is to remove the conflict entirely if possible, or at least disclose it so clearly the client understands the potential influence.
Okay, so we've covered the advisor's character, if you like integrity and objectivity. Now let's shift to how the service is actually delivered. Competence and confidentiality.
Right. Professional competence and due care. This isn't just about being smart, it's an ethical mandate. Advisors absolutely must keep their knowledge up to date.
And that's not easy, is it? The financial world changes constantly.
It really does. Tax laws change, pension rules shift, new investment products appear. It's a moving target. Clients are relying on their advisor to understand all this complexity and interpret it accurately for them.
So things like continuous professional development, or CPD.
It's not just a box-ticking exercise for regulators. It's a fundamental ethical commitment. It's about ensuring you're providing the best possible standard of advice and protection. If your advisor isn't constantly learning, honestly, they could be putting you at risk without even realizing it.
That's a strong point.
Okay.
Okay, the final pillar, confidentiality. This feels incredibly important given what clients share.
Hugely important. Think about it. You tell your advisor everything. Your income, your debts, your assets, maybe health issues, hopes for your family, fears. It's deeply personal stuff.
Very vulnerable position.
Exactly. So the ethical duty to protect that information is absolute. Our sources are clear. Advisors should only share client info if the law requires it or if the client gives very clear, explicit permission.
And in today's world, that's not just about keeping quiet, is it?
No, definitely not. It's also about data security.
Yeah.
Ethically, firms need to invest properly in systems to protect that sensitive data from hacks or breaches. Because a breach of confidentiality, even if it's unintentional, say through carelessness,
He didn't do serious damage.
massive damage
Yeah.
financially and to the client's reputation. And it destroys the advisor's reputation, too.
Right. So those are the 4 pillars. But life isn't always neat categories, is it? Advisors must face situations where the right answer isn't obvious from a rule book.
That's where professional judgment and that moral compass really come into play. It's the true test.
Can you give an example like that high-risk scenario you mentioned earlier?
Yeah, let's revisit that. Imagine a client comes in, maybe they're caught up in market hype, or they have a sudden urge to make quick money, and they demand to put a large chunk of their savings into a really high-risk investment. Now, the advisor knows this clashes completely with the client's long-term goals, their risk tolerance profile, everything they've discussed before about financial security.
The easy route is just to get them to sign a waiver, right?
Yeah.
Your money, your choice. Collect the fee.
Legally, maybe. The waiver covers the legal risk for advisor or the firm. But ethically, the duty of care demands more.
So what's the ethical action?
It means prioritizing the client's actual best interests, their long-term well-being. Even if that means having a difficult conversation, it means challenging the client, making sure they truly, truly understand the potential downsides, the real risk of loss, and how it could wreck their financial future.
Even if the client pushes back.
Especially if they push back. The ethical advisor sometimes has to protect the client from their own impulses, guiding them away from potential disaster, not just facilitating a transaction.
That takes courage.
Yep.
Let's also talk more directly about conflicts of interest. We touched on it with objectivity, but it's such a big theme.
It's probably the single biggest ethical hazard in finance, yeah. Because conflicts are often built into the system. Situations where the advisor's personal interests or their firm's interests could sway their recommendations or even just appear to.
And the appearance matters too, doesn't it?
Yeah.
For trust.
Absolutely. Perception is huge. Ethical practice demands, first, radical transparency about any potential conflict, and second, wherever possible, you eliminate the conflict altogether. If an advisor gets paid more for selling certain products, that needs to be crystal clear, and the firm needs systems to manage that pressure. Otherwise, the advice is inherently suspect.
And this links back to the firm's culture, doesn't it? An advisor might want to do the right thing, but if the company culture pushes sales above all else.
Exactly. Individual ethics struggle in a toxic environment. If the firm's incentives, the targets, the whole message from the top is just about hitting numbers, advisors feel enormous pressure to cut corners, ethically speaking.
So leadership is key.
It's crucial. That's why things like the senior managers and certification regime in the UK, for example, are important. They put the onus on senior people to actively build and maintain a culture where doing the right thing for the client drives decisions. Ethical failure often starts right at the top.
So let's try and bring this all together. When we're talking about ethical advice, what's the real difference between someone just following the rules and someone truly acting ethically? What's the bottom line for you, the listener?
I think the true test is that ability to pause and reflect. For an advisor to step back, even mid-transaction, look at those 4 pillars: integrity, objectivity, competence, confidentiality, and ask themselves honestly, is this the right thing for my client? Not just legally okay, but right, considering the long-term impact.
Considering fairness, consequence.
Yes. Not just the immediate commission or closing the deal. It's about that longer view.
And you mentioned earlier, this isn't just some abstract moral ideal. There's a solid business reason for this.
Oh, absolutely. It's not just morally right. It's smart business. Consistent ethical behavior builds incredible loyalty. It leads to referrals. It builds a reputation, a trust capital you just can't buy.
And avoids problems down the line.
Definitely. It reduces the risk of complaints, regulatory fines, lawsuits, all that negative stuff. So upholding these principles, valuing people over quick profits, it protects the client, yes, but it also safeguards the advisors and the firm's own future. It honors the trust people place in them.
So this deep dive really reinforces that the ethical compass has to point beyond just what the law strictly requires.
It absolutely must. Which leads us nicely to our final thought for you to take away.
Okay.
We know knowledge is most valuable when you understand it and can apply it. So, thinking about the 4 pillars we discussed: integrity, objectivity, professional competence, and confidentiality, which single one would you demand clear evidence of before sharing your sensitive financial information with any professional?
That's a tough choice.
It is. But think about which principle you feel most fundamentally protects your long-term interests and vulnerability in that relationship. Something to ponder.